We've helped hundreds of clients build better construction companies.
We love this business, we love the people, and we've seen what running a successful, profitable business takes.
And we're sharing it all with you here on Construction Hot Takes.
All right, on today's episode of the Construction Hot Takes podcast, we're going to be talking about private equity in the construction sector from the private equity side. What are they looking for? How do they leverage us to help them in the due diligence process, the post-acquisition process, the scale and grow part of the process with their construction and trade service acquisitions?
All right, so we're talking about private equity and how exactly that works from the private equity side and kind of what they're looking for in contractors. We've talked a little bit about being a contractor. Let's dive into that a little bit deeper. So let's look at this two different sides. What does it look like pre-acquisition, post-acquisition, and kind of the growth side of things from the private equity side first? Let's talk there, and then we'll talk about it, but we'll look at it from the contractor side. Is that okay?
Sure.
All right. So let's talk about pre-acquisition. What does that look like as a private equity firm? Well, and how do we as Ascent help them with that?
Gotcha. So I'm going to start by saying I don't know everything about private equity and how they think. They are investors. They look at a lot of different things. They talk in finance numbers. They don't usually talk in operations language, right? So they're looking at this as an investment that they can grow, that's going to generate a rate of return that's acceptable for their investment, their equity, their banking partners, the people who actually have the capital, wherever that money is coming from, whether it's in-house or third-party money that they are getting. They are, as we said, they're kind of like fund managers for a mutual fund. They are looking for assets that generate a return, and the ones that we work with are not construction sector specific and exclusive. A lot of times they're buying businesses in other sectors too, and they have people on the team that work in the construction sector. So those people at the firm are like a subset of the whole team. They're looking for assets, and they have their own criteria, Greg. We've talked about this. They might be just looking for HVAC companies, or just looking for plumbing, or going after MEPs, or maybe they're trying to buy in a certain geography and have a couple of each kind in a certain area. They vary a lot.
Well, and further to that, the only other thing to add to that, I think, is we can't speak for all the private equity firms what they're looking for. Each firm has a mandate.
Sure.
Each investment committee, that's what it's called, right? So you hear it called the IC. What does the IC want us to get? A company might have an EBITDA of 5%. They might only need it to get to 7 over the next 5 years. That might be enough for them. So that's up to that. That firm is looking at what they need to do. Can this business, before they're acquired, go from a 5% EBITDA to a 7% EBITDA? If so, great. If they want that to go to a 20% EBITDA, which is really high, but
huge,
then that might not be the right firm for them, so they're not going to look at that company, and that due diligence stops, right? Each firm has their own strategy for what they're looking for.
So in the past, when we've been involved with the due diligence piece, what was our scope of work? What did we provide?
Well, I think back to the one we did in New York, right in the beginning. So they were looking at buying this company in New York, and private equity hired us to augment their own due diligence process. So their due diligence was very financially focused. They brought us in to say, is this company really who they say they are? Operationally, are they structured to 2 or 3x the business over the next few years? Is there market share for them? Can they handle that market share if we get it for them? Do they have infrastructure that will support this? Will their software hold up? They let us look at everything.
Does this owner actually know what he's talking about, or is he talking a really good game for us at the table, and then when we leave, is he like, I'm not sure what I'm doing here? So that kind of behind the scenes backside, like on the backside of their due diligence, we come in behind them and do more due diligence with our third party eye, very dispassionately. It's not our investment, it's not our company, we're just saying what's happening.
We can test out what they're telling us, like this is the process and how we do it, and we ask enough questions around it that we can determine, does that actually happen Or are you just telling us that because it sounds right?
Yeah, and the other thing is, we've worked with over 250 construction companies at this point, so we know what industry best practices are. We've seen a lot of different ways that companies successfully manage their business operations and their projects. So we can come in and look at how that's being done by this potential acquisition and say, yes, they seem to be operating, according to pretty traditional methods, or they're doing something unique, but it makes sense for them, or these guys are completely disorganized and they're running this business with spreadsheets and QuickBooks, and it's not going to hold up when you 10x it.
Smoke and mirrors is the phrase that comes to mind. Lots of smoke and mirrors.
Mom and pop might be a real mom and pop shop, and private equity just wants to know what they're buying.
Yeah, we had a client that private equity thought they were buying one kind of company, and it turns out when we got there,
That was a good one.
it was that kind of, but it was also a whole other thing.
was a
It
lot
a
more than
manufacturing
that.
piece to it.
Yeah.
They didn't even know about,
The
right?
whole construction arm they didn't realize they were
Right,
buying, and
right.
the construction arm was the part that was struggling.
Yeah.
And they thought they were buying they thought they were buying an energy storage company, and when they wound up buying was a design build electrical contractor, not realizing it. It was that was a fun one.
Yeah. So all right. So we can help on the front end to help them understand pre-acquisition. Here's a little bit more information. Do you still want to do this deal?
This is what you're actually
right.
buying. Here's
Right.
Here's what's in the bag.
You know
Here's
what
how
you're
the
about.
sausage
Here's
is
what
made.
you're about to get into.
Yes.
Yes.
If your numbers work, here's some more stuff you'll know about. So post.
And if you do make this acquisition, here's where you're going to want to focus your investment up front to shore up the infrastructure.
So post-acquisition, it probably wouldn't look all that different from our perspective. We're going in and we're asking those questions and we're digging in to understand how does this business run and what's going on and what needs to improve to meet maybe some goals or criteria that the private equity has set. Like, we've got some growth goals here.
The biggest difference at this point is that they've already bought it.
Yes, right.
They've already made the acquisition. Now they're typically going, okay, now let's bring a third party in and let's put together a plan for how to scale this business up. And at that point, we can't stop the sale. Like
It's
that one we
happened.
just
It's
talked
done.
about, the sale is done. They've now bought they've got a bill of goods. They've bought a business that is operating the way it's operating.
Yeah.
And now they have to try and fix it now that they're owners. It's kind of, we would say, an analogy of like, you can put the airplane in the hangar and fix it before you take off, or you can start bolting stuff on as you're going down the runway. They
One is
bought a
preferable.
business.
Yeah,
The former is preferable
Yes.
for most people. You brought up a good point, though. When you, I guess, in the question, though, it's what matters to the buyer,
Yeah.
right? Sometimes they want better margin. They want better, like they want a better EBITDA. They want higher margins. They want higher gross margins, and they want higher net margins. Fine.
How do we lower costs?
How we lower costs
How do
and
we
yeah.
raise prices?
Sometimes they want there to be a new system, a new ERP, because they want to systematize across maybe 5 other portfolio companies.
Right.
Sometimes they want to understand if the management team knows what they're doing, so they can either sunset that management team, or they can bring someone else in, or they can say, you'll stay and you need better people, right? So like team assessments. It depends what that investor wants to focus on after they've sold or after they bought.
To be purchased. Yeah.
Because it's not always the same thing, and it's not always everything. Some things are working well, that's why they bought them. But some things need to be either fine-tuned, or some things need to be retooled so that it fits better into their purchase strategy.
Right. So we've gone in when it's literally could be everything. It could be anything.
It could be
We
everything.
need a holistic look at this business.
Right.
And sometimes it's no. We've got to
Like our
we un-
operational assessments.
an operational
Do
assessment.
those.
Other times it's maybe more focused. Like just take a look at the sales and revenue side of this, or take a look at the accounting.
We've got one
or
right
take a
now
look at
that's
the
like, we want you
operations.
to come in and take a look at all of our accounting processes. We know we need to get off of our current accounting system and do something new. We need to make sure that our accounting processes are shored up, and then we're going to need help evaluating and selecting a new ERP.
Okay.
So they don't want us to look at field operations at all. They feel field operations are fine. We're only focused on the back office and the accounting and finance piece to start with this new one.
So if, I guess looking at this from a little different angle, instead of in all of these cases, our client is the private equity group, right? We're not Have we ever had a case where this circumstance is happening, but we're working for the contractor?
The
I don't think it's ever happened.
The technical answer is yes. Private equity has hired us and told the actual company to write our check and sign our contract.
Right.
Like, because private equity controls the business, they just tell the construction company, you're going to hire these people. You're going to please sign this proposal and add them as a vendor and pay their invoices.
Which-
they kind of require them to do it.
Which is not always a good thing. I mean, that's we have examples, right?
It's less than ideal.
It's well because the person who's being assessed may have there may be an inkling that something's up, right?
Yeah.
There may be an inkling that I'm on the way out, and who are these people that we brought in? But it's the money, right? Because money always talks. It's the money that says, I need to know what's happening here. I need to know what's happening, and I need to know the truth. And I don't need the person whose job is on the line to say, oh, everything's perfectly fine.
Right.
No, those reports, absolutely accurate.
And we've had both. We've been brought in where legacy ownership, as we'll call them, the pre-existing owners who went through the sale, they're still there. They are very happy. They are happy that we are there. They are excited that private equity is investing in their business and bringing in third parties to help them. And we've had it where they were very suspicious of us and wound up being exited from the company afterwards. We felt like the Bobs from Office Space.
During sometimes.
And we've had it kind of in the middle. We've kind of seen the whole spectrum at this point. It's always more enjoyable when the ownership and the leadership at the companies is excited about having us there. We are really there to help. Sometimes we're there to help fix problems, and sometimes we're there to help put a plan together for growth. And sometimes those two go hand in hand. There's some problems that have to be fixed in order to make them scalable and able to grow successfully.
A lot of what happens too, because we're talking about the phase after acquisition, a lot of what happens is these owners or the management team who's been running this business, say, for 10 or 15 years maybe, they've been doing everything the same way for as long as they've been there, right? Or they founded the company, and now there's a new owner. There's a new person at the table who has a voice who says, why don't we change this? Why don't we try something new? So that takes a little bit of that's stressful to some people who say, well, I've been doing the same way every day. I'm fine with how it's going. Well,
you bought me because I was successful. Why would we change?
Why would we change? Or, okay, it's not so bad. I wouldn't mind having higher margins. Maybe these guys know what they're talking about. Let me run through the, field with them and follow along and see what happens. And that's and it's both those. It's absolutely both of those.
So, how long does this normally take?
So the assessment, an operational assessment, is typically for us 30 to 60 days. It's a little bit of prep work ahead of time. Then we come in, we do 2 to 5 days on site, depending on how big the business is. And then we come back and put together our gap analysis or our roadmap for success. And that's usually 15 to 20 business days. So the whole thing is, a month, 45 days for an assessment. Getting into ERP stuff or bigger engagements where we're going deeper and we're actually,
Helping you select a new ERP or putting new processes in place.
Process.
I mean, those things can be 3 months to a year, depending on how big the company is and how involved we are and how many departments. When we've done complete, start to finish reorganizations and restructuring, like that one that we did for the big company a year or so ago, that was 10 months.
Yeah.
And we had to help install a new management team and everything. We've had other ones that were 4 to 6 months and we're in and out and because a little more focused.
We're working on one right now. We're working on a focused one now that focused on one area of the business. They were very happy with our work, so they brought us in to look at another area of the business.
Right, and that was like 3 or 4 months.
It was like 3 months.
For that engagement, the first one?
4 months, I think, total, and now the next one's going to be 6 weeks because it's a smaller, area. But that's very common that you just want to focus on the things that you have identified as the investor. There may be a problem. Now, if we find something else while we're there, we'll let them know. We'll move on to the next thing.
So briefly, where do you think? What are the let's say top 2, maybe top 3? What is the biggest value that we're bringing to it? Could be mostly probably to the private equity group, but maybe to the contractor that's being the seller, I guess. But where's our value here?
Well, I think I said before, part of the value is we are construction people. we know the business. We know what it could look like, what it should look like. We've seen how hundreds of other companies run successfully, and we've helped so many of them change little things, big things, reorganize, structure, grow, scale. So one of the biggest values I think we bring is that we speak the language. We've walked the walk, and this is all we do day in and day out is help contractors be better businesses. So you're getting somebody who you don't have to explain, the basics to. We're going to pick up really fast on how your business runs, how you want it to run, how private equity wants it to run, and what's needed. What's that gap? How do we get it from where it is to where you want it to be? I think that's one of the biggest values that we bring.
I'll add one thing to that. The other value, I think I said this earlier, we are dispassionate in our work. And I don't mean that we're not passionate people, because I think we are about our work. What we are is, if you are an owner of a business, or you're a manager of a business, or you've been at a business for a long time, and you've been there 10, 15 years, and you live and breathe and sleep that business, and someone comes in and says they want to buy you and they're going to change everything, you have a lot of anxiety around that. You have a lot of stress around that. You have a lot of worry around that. If you're a private equity person, you have money on the line. You've got either your money or someone else's money on the line.
There's probably a clock attached to that.
There's a clock attached to it, and you're like, did we make the right decision here? Is this the right business? And if we need to change anything, we need to change it, and we need to make sure it works, and we need our strategy to be right. We come in as that kind of fulcrum point, like we are there to help. We're there to point things out. If A needs to be changed into B, then we're going to point that out. And I think that's valuable to both sides, because we're not there to judge people. Right. We're not there to tell them that they're the worst people in the world. We're there to make their businesses better, and that helps both sides of the equation.
We're unbiased.
We're unbiased.
The group I worked with in Florida last year, the equity side told me at the end of the project, he said, what you uncovered in your process in roughly 30 to 45 days, I would have found it, but it would have taken me a year.
Exactly.
Because I'm not in this business every day. I have other businesses that I help run. You did it in everything. He's like, yep, 45 days. You had it all figured out.
And time is money, after all. We all know that. So that's 100% right.
And that's something we hear from private equity a lot is, look, they're not construction business experts. They are investors. And they need construction business experts on their side, as part of their team, to help identify those problems and to come up with solutions for them and help implement those solutions so they can stay investors and not become investor operators.
They don't want to. Sometimes they do. We've seen wherever the investor side, like the PE side, will have someone on site and they're there kind of every day, but that's not usually the best.
Smaller investors.
But that's not usually the best use of their time. Their best time is being investors, tracking the information that is given to them, and looking for the next
finding
investment.
Other deal to put the money at work, right?
Yeah,
right.
I mean, we think about the one in Texas right now. They're trying to acquire 18 more companies in the next 18 months. Mm-hmm. They don't have time to be in the weeds fixing problems in the business. They want us to do that so they can just go out and manage the fund.
Perfect.
So, Greg, I think one other way that we really help and can bring value to this equation is that we understand how private equity thinks. You've got an investment background. We've worked with a lot of PE companies. Right. I mean, I'd love to hear your thoughts on that.
Yeah, I think what we bring to the table is the ability to look at an investment that's, been made by someone else and say, okay, what are we working with here? If you're a small time investor and maybe you're a small, with one-man shop, you're just happy to get some kind of financial reports at the end of the month, right? But if you're a PE firm and you have an infrastructure, say you're a $100 million, $500 million private equity firm, you need what you need in order to satisfy that investment committee that to whom you report. You have to get you have a boss there somewhere who's probably like the managing director who wants to check in on those investments every week across the portfolio. So we know what private equity needs because like you said, I come out of that world. Mm-hmm. I've been on the investment side of construction businesses and development and real estate, and I think it starts and ends with reporting in this frame of mind. You have to have good, accurate financial reports. You have to get information out of the business that you can trust and rely on. What you do with that is sort of up to you, but you have to have a way to get accurate data out of the business so you can look at your own investment and say, how are we doing here, right? So that matters. And then the other thing that I think that we know is you have to be able to look at a construction team, right? Their operations team, their estimating team, their accounting team, and actually do an assessment on those people who are running your business every day. You own the business. They might still own part of the business too, but they're working for you in a company that you now own. And we know what they want to see. They want to see a good bonus program, probably. They want to see good attendance. They want to see good usage of software, right? All the things that we know it takes to run a construction company, we know how to translate it into what the private equity firm needs to see, which is data and output and KPIs. And then we can translate that through our prism of being construction people back into the prism of what does an investor want to see out of this? And I think it's those things. Thank you for joining us on our podcast episode today about private equity. Please join us the next time on our Hot Takes podcast, and listen to us anywhere you get your podcasts, on Spotify and Apple Music. And be sure to visit us on our website at ascentconsults.com.